Anything that can go wrong will go wrong. And this week in the markets, political uncertainty brought the volatility amidst a sector and size rotation into smalls out of tech. So was last week's price action a reason for us to get out the market, or simply a great dip buying opportunity as second quarter earnings gets underway? That's what we're here to talk about, so let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Let's get into it. This is the weekly heat map of the S&P 500, and it's very obvious to see the type of trade we had this week. The growth names, tech, software, semiconductors all got sold off violently. Nvidia down 8.75%, Microsoft, Apple down 2 and 3%, Google, Meta, Amazon, Tesla, as well as Eli Lilly, all of these software names, they all got sold off this week, and the broader market really did gain in light of all of this. And despite all of the headlines, the broader market did gain, particularly in energy, real estate, and financials. They were up 2.04%, 1.3%, 1.1%. So rate sensitive names and commodity driven names really drove a lot of the price action today in what was a pretty volatile week, particularly from Wednesday. Thursday, we really saw a lot of sell side in the broader market, especially in technology. Technology was up here Tuesday into Wednesday. It gapped down, made lower lows, down 5.53% for the week. It was very brutal, and you could see that weighed on the entire market. The Nasdaq 100 was down 3.64%, the S&P 500 1.97%. Bonds did lose because yields went up. That had to do with some of the political uncertainty we saw this week, but the RSP, the broader market, actually flat here on the week. The Dow Jones gained, especially when you have financials, energy stocks gain, as well as healthcare stocks. The Dow Jones is going to do very, very well. And then the IWM, the best performing stock as a whole, up 1.74%. But something we do need to pay attention to that happened this week. Into Wednesday, the IWM was up 6% for the week at its peak, and it pared so much of its gains into the end of the week. There was violent selling across the board Wednesday, Thursday, into Friday, into the end of the week here. And this is something we do need to pay attention to, because if you look at this headline figure, you say things look good, but then you actually dive into the specific days, into the details, and there was some pretty brutal action across the board. It did look like there was a bit of dip buying here on Friday. We sort of did level out towards the end of the week. Maybe this is a sign that things might actually continue to the upside into next week. Just something that you need to pay attention to. But if we actually dive a bit deeper into small caps, we actually saw that small cap value, core, large cap value, mid cap value, the value complex across all sizes was actually up this week, 2.5%, 2.7%, 3.8%. What really weighed on the market was large cap growth, growth momentum, and quality. These were all red. The rest of the market was actually green this week. Guys, we're going to dive into the IWM. Yesterday, we looked at the S&P 500, and we're going to dive into the IWM, my expectations for the week ahead, as well as giving you an overall analysis from the monthly, weekly, and daily chart. Now, the month is not over, but you do look at the IWM from a monthly chart. Things are looking very, very bullish, but we're not going to dive into it simply because the monthly chart is not done. But looking at the weekly chart, let's actually just remove all of these drawings, and going on a 5-year chart, you can see very, very clearly we are in an uptrend in the IWM, so you don't want to fight the trend long term. Now, we actually did have a pullback from the highs right here, both a price correction as well as a correction in time. You can see that we did, however, on the weekly chart relative to this low, we are putting in a higher low, and we are breaking in above some very, very key levels in the IWM. Now, let's actually dive a bit deeper into some of the price action we saw here this week. Now, again, this is the weekly chart, and you can see from the October, November lows here in 2023, we've put in a low and since made higher lows all the way to a 52-week high right here, wick high, as well as a closing 52-week high, and at the same time putting in new highs. Very bullish when you look at this in aggregate. However, this candle right here, the structure, not looking too good. Now, it is a green bodied candle, and we did finish the week up 1.74%, but there was a massive wick at the top here. But that goes to show that to have a massive wick, you had to have a huge impulse to the upside, but also a huge impulse to the downside. So I would still call this technically bullish in the IWM. I'm not getting bearish on this. I think the fundamental picture is far different, but we are at a very, very critical zone. And that first zone is right here, the 209 level. Actually, we would just call it the 210 level. And it's very obvious to see why this is such a key level here at 210. It's actually where we kind of started the breakout to the upside. We use the 210 level as resistance right here, and then resistance turn to support. So we do have a bit of room to the downside. The IWM is currently at 216. If we are to pull back to the 210 level, use as support and then go from there, that would be bullish, and then we just continue the rally as is. However, if we do break below the 210 level, that's where things start to become ugly, because this entire rally is predicated on pretty much rate cuts and earnings expectations coming in better than expected. If we actually see a breakdown below this level, that is the market either pricing in worse than expected earnings, or something has changed in the macro environment. As long as we're above the 210 level, rate cuts are here and earnings should come in as per analyst expectations. And we are going to cover IWM earnings this week. Hint, hint, it's very close to 18% quarter over quarter for Q2. Going from the weekly into the daily, we can see a bit more nuance and not much to add on the IWM. Firstly, I do just want to point it out that 210 it remains the key level on the weekly and the daily chart, and that's how you know it's a very key zone. So if we do pull back, we need to find support right here, because below the 210 it gets ugly for the IWM, but above we can bounce, break these highs, continue the movement back to all-time highs, which I do think that's where we're going given the overall macro picture and the fundamental picture. However, there's a couple things we do need to be worried about. Data this week, we get PCE data and GDP second quarter. If we get GDP above 1.9%, right, expect the rally actually to continue. Here's the thing, because economic data has come in so much weaker than expected in the last 3 to 4 months, but particularly the last 4 weeks, if we actually get GDP above 1.9%, I think anything from 2 to 3% should be good. If we get above the 1.9%, I think markets are going to rally on the back of that, because generally speaking, GDP and earnings are highly correlated. If we get better than expected GDP above 1.9%, and we actually get PCE that's in line with market expectations, or even cooler like we saw with CPI, which may be the case, if we get those combinations on Thursday, Friday, expect the markets to absolutely rip, regardless of anything else except the political situation. When it comes to the politics front, Donald Trump, Biden, Republicans, Democrats, that can really move the market in ways that is really like we really don't know. Election uncertainty is one of those things that comes around once every 4 years, and every single year election seems to be more divisive than the last. And so that can really cause the market to move in ways you don't expect. But as it is right now, guys, for the IWM, we want to be buyers of dips at the 210. If we get there, if we do get below the 210, I'll give you guys an update a little later on in the week. But I personally expect us to find support at the 210. If not, we should just continue the rally Monday, Tuesday into the rest of the week, onward and upward for small caps. Now let's talk about sentiment. And guys, we saw a bit of a divergence in Goldman Sachs sentiment indicator and BOFA's indicator. They normally move in lockstep, not this week, which probably goes to show how they weight the components of this. Maybe this is weighted more to some of the larger cap names, and this is more of an equal weight. So we saw the BOFA Bull Bear indicator move up to 6.5% to 6.5 from 6.3, whereas the Goldman Sachs sentiment indicator actually moved down to 0.6. However, you do have to understand that this is still above the zero line, and you can actually go below. We just haven't, because we haven't really seen a lot of volatility, but we have moved out of stretch positioning into this baseline area, which is still bullish above the zero line, and BOFA's indicator actually tick up further towards the sell side, in other words, to the oversold territory, which would be bullish, and that goes to show just a bit of the dynamics in trade we saw this week. However, what these indicators are telling us is that if you are holding longer term positions, you do still want to hold. But what this indicator, Goldman Sachs indicator, is telling us that you do want to nibble on certain names that you think is approaching value. I know some of the semiconductor names on a peak to trough basis are down like 10, 11, 12%. And that is juicy. Generally speaking, I have a rule that every 10% pullback, I load up in a very big way, because the average S&P 500 correction is about 13%. And the average S&P 500 bear market is about 22%. So if you load up at each 10% increment, you tend to load up at near bottom levels unless we go from a correction into a bear market. So guys, if you are holding equities, hold. We will go higher. I think we are going to make new all-time highs, and start to nibble on the names you do like, especially as we have a lot of names reporting this week, a huge week of earnings, particularly after Tuesday. Here on Monday, we have NXP, SAP, Medpace holdings. If you hold a lot of small cap quality ETFs, Medpace is one of the biggest positions in that. So we have to pay attention to this. Cadence Design Systems, a semiconductor, and a couple of other names I'm not too sure of, Verizon as well. Then Tuesday, we have Spotify, Tesla, Alphabet, Coca-Cola, GE Aerospace, GM, Visa, Enphase Energy, Chubb, Texas Instruments, Capital One. We got the whole stock market reporting here on Tuesday. Then Wednesday, Chipotle, ServiceNow, IBM, Vertiv, AT&T, a whole bunch of names, Waste Management as well. So a very big Tuesday, a very big Wednesday, and then we cool a bit off here Thursday, Friday, but there's still a lot to be had. AbbVie Health, American Airlines, Texas Roadhouse, Deckers Brands, they're all reporting on Thursday. And then Friday, we have Bristol Myers Squibb, 3M Charter Communication Services, as well as Colgate Palmolive. Big week of earnings, particularly on Tuesday. The market cap reporting here on Tuesday is just insane. So expect volatility. Now, where do we stand for earnings? The S&P 500 second quarter earnings is currently at 11.1%. Now, this was analyst expectations at the start of earnings season here at the start of July. So we are beating expectations. I think this number might actually be closer to 9%. Nonetheless, we are beating earnings both for the S&P 500 and excluding energy, but not so positive year on the revenue side. 4.5% is currently reported. 4.6 is what we were expecting at the start of earnings season. However, only 70 companies have reported earnings. About 150 to 200 companies will have reported by the end of this week. On the Russell side, we can see that things are not looking too good, although only 57 companies have reported. 17.5% earnings growth currently. At the start of earnings season, the expectation was 18.4. So we've seen a little bit of a down revision. Actually, that's a pretty big down revision. And then 28.4% growth ex energy. And the revenue has actually remained unchanged. One thing that is a red flag, in my opinion, is that in terms of earnings is entirely driven by healthcare as well as real estate, which is essentially over-levered office space and biotechs. That's really what these two sectors. So the entire Russell 2000 earnings, the entire small cap complex is dependent on over-levered and unprofitable healthcare names and real estate names. So it's going to be very, very dicey. If these guys don't hold up with the amount of earnings decline we're seeing, it could get very dicey. And this is why I've always championed small cap quality. And last week, I gave you guys a bunch of stocks. I said these 4 stocks, these small cap stocks, will outperform the Russell 2000 and be completely unhinged over the next 3 to 6 months. They were Mueller Industries, MLI, Paycom Software, PAYC, PKST, Peakstone, Realty Trust, as well as Installed Building Products. Now, I don't own any of these names except for Paycom Software. I don't own this portfolio, but I did go ahead and equal weight them just to see what was the returns had you purchased it the next open after I gave you these stocks. And this is the performance so far, 18.68%. I know it says year to date, but I actually started the portfolio here, which was the 10th of July. And up 18% against the Russell's 8% in the exact same period. And I do think this portfolio is going to do very, very well over the next 3 to 6 months. You could see anywhere 50% return plus, and Peakstone Realty also pays an 8% dividend. You can definitely get some fantastic returns in a portfolio like this. So for those of you that don't want direct exposure to the IWM, this is a great alternative. Diving into some Russell stats and what are our expectations for the next 3 months, 6 months, and year in the Russell. Now, this is Russell 2000 forward returns when the 5-day rate of change crosses above 10%. What can we expect? We have a huge pool of data, but not so much data that it becomes overwhelming. And you could see 3 months on, median returns 7.1%. Average returns 13.6%. Crazy. 6 months on, this is where it gets crazy. 6 months on, 12% median, 20.1% average. 1 year later, 20.8% median, 34.71% return, 82.4 and 100% hit rate. Every single stat has been positive 12 months later when the 5-day rate of change crossed above 10%. So the dip we are seeing in small caps, you know, the pullback we saw from Wednesday's high, if that selling continues, you do want to be a buyer of that dip because the data is telling us onward and upward in the week ahead. And at the same time, markets haven't peaked yet. According to BOFA, 50% of signals triggered today versus an average of 70% in prior markets. This is for the S&P 500, and it's pretty much telling us that the S&P 500 still has a lot of gas left in the tank. Now let's dive into a bit of the macro, and we've looked at this chart quite a number of times this week. This is the Citigroup's Economic Surprise Index. It's just for the United States, however, and you could see that economic data been a bit of a dumpster fire here in 2024 since April. Anything above the zero line right here is economic surprises coming in better than expected, below worse than expected. And while we have seen data significantly below the zero line, we have seen a little bit of respite that was on the industrial production as well as retail sales data we got earlier this week. So we've seen data come in a little bit better than expected. And at the same time, as we have gotten worse than expected data, economic policy uncertainty has actually moved to record lows. And that just goes to show the environment we're in. Long story short, what we needed was worse than expected data in 2024 to confirm rate cuts by the end of the year, and that's exactly what we got. And this is why we've seen some of the lowest economic policy uncertainty, pretty much telling us before the end of the year we're at least going to get 25 basis points worth of rate cuts. But that's all going to be dependent on data we get this week. Now, we have nothing scheduled on Monday, nothing major actually. Then Tuesday we have existing home sales, 3.95 million is the forecast. Then we have the PMIs on Tuesday, 55 and 51 is the expectation. Remember guys, anything above 50 is expansion, anything below is contraction. Thursday is when things heat up. We have GDP data for the second quarter. 1.9% is the forecast. Fed's GDP now is sitting right now at 2.4%. I think anything above the 1.9% area is going to be really, really good, particularly with the economic surprises we just got this year. Data has been quite weak since April. If we get better than expected GDP, I think the market's going to take that as data improving and not an inflationary scare. So I think if we get anything from 2 all the way to as high as 2.5%, the market should see that as upbeat. Then we have the usual initial jobless claims. We also have durable goods on Thursday with the GDP, and then trade balance and retail inventories, but that shouldn't matter too much because we got retail sales last week. And then Friday we get PCE, personal income outlays. The expectation, the headline for that is 0.1 and 2.5% month over month, the year-over-year figures, and then the exact same numbers for the core. That is the forecast right there. And then we get consumer sentiment. Now here's some interesting stats with regards to PCE that I have. Now since September 2022, this is the 5-day, 1 day before, 1 day after, 5 days after, and the 1 month return into a PCE report. And you can see that leading up into a PCE report, returns tend to be fairly lackluster. Once we do get the certainty of that PCE report though, we then see really good returns 1 day, 5 day, and 1 month after. Average return 1.31%, hit rate of 61.1%. So if we do get a bit of a choppy week, it's to be expected, but lackluster returns around this time of year is not uncommon. This is S&P 500 seasonality for July, and this is the period where we are right now, the 18th of July right here. And you could see that we normally do get a bit of downside up until the 24th, 25th. That's when we normally form a bottom and then move higher. So what we're actually seeing right now is completely normal seasonality with regards to the S&P 500. At the same time, looking at election year seasonality, you can see what normally happens is we get a sideways Q1 and a stellar Q2. What we've actually done is have a stellar Q1, a stellar Q2, and this is where we are right now, about halfway in the year. And what normally comes after is sideways market momentum, and then actually down here in the S&P 500 leading up into the election where there's a lot of uncertainty, and we actually saw that this week. Once we find out who the president's going to be, we normally form a bottom and continue a very, very strong end of year rally, eclipsing the highs we previously made. And for the S&P 500, that would probably mean new all-time highs into 2025.